Oh, and in the second lesson, we're going to be talking about liquidity in the marketplace. So first, what is liquidity? Liquidity is money that other traders have set into the market. And basically, liquidity is when a trader has a position opened at a certain level, alright? So when the trader opens a position, that money is getting taken into his account, and that money is getting taken from his account and is getting put into the market. And depending on what the market does next is what happens to that money initially set into the market. So if the market doesn't go his way, that's a loss to you and the win to the market, as that money is gonna go to the people who traded the correct bias. And what that means is, let's say you have a long position because you think the price is gonna go higher, but instead the price trades lower, taking out your stop. And let's say you're risking £50 in your stop, and then when you got hit, that £50 is going to someone who had the correct bias and opened a short position going short. And that's what liquidity basically is. And where we find liquidity is above and below buy stops and sell stops. And a buy stop is two things. One is where the majority of traders will keep their protective stop going short, and secondly, it will be where traders have their limit order going long, right? And the limit order is an order where if price reaches that price or hits a certain level, then a position would get opened. And the sell stop is just the opposite. First, it's where the majority of traders would keep their protected stop going long, and it would also be where traders have their limit order going short. It's not gonna make a lot of sense right now because it's just words, but when you put this into the charts, you really begin to see what is liquidity. And we find liquidity above certain points. And the easiest way to find where there's a pool of liquidity is with the equal highs. And it's just a common candle formation. It's just two or more candles with equal or relative equal highs. And the significance of the equal highs is that there's going to be pools of liquidity above it. And the market moves just in two ways. The market's either going from liquidity to liquidity, or the market is going to fill an inefficiency. Just keep this in mind, and it will be and it will be more clear to you later in the course. And there's equal lows. It's just the opposite. It's where there's a bunch of candles, or two or more candles with equal lows or relative equal lows, and there's pools of liquidities under it. So let me show you in the charts. Right now we're at the 1 hour, and you can see here is equal lows and here is equal lows. So I would say this is a point of sell side liquidity. So let's write that. Just to clarify, I'm looking in this area and ignoring everything to the left and to the right. So just keep your main focus on this. Let me make it bigger. Alright. This is our sell side liquidity. And here there's buy side and buy side. Yes, right. It's gonna be. And the reason it's buy side liquidity, as you can see, a bunch of equal highs. That's sell side because it's equal lows. And so as you can see in this example, price traded all the way up here, taking buy side liquidity, before coming down and taking the sell side here and all of the sell side liquidity here with all of these equal lows. You can mark that out as well. More sell side. So let's say, and the reason why there's going to be money under these points, I mean under or above these points, is because think of it this way. You're a trader and you're betting that the price is gonna go up, alright? So you see, price went up here, traded lower here, and here you're thinking to yourself, this is a good time to go long. So I would open my long position here. Let's say keep a target up to here, for example, and we'll keep our stop loss below these equal lows. Price will go up for a bit, take out the buy side liquidity, and then go all the way down and take you out your stop. And what's also nice, and not what also nice, but what also makes sense is that the buy side liquidity is, don't look at it as buy side liquidity, look at it as a level of resistance. And what does the book say about resistance? Is price should go up to it and go back down, go up to it and come back down, right? And when price trades through the resistance, that's a break in the resistance, meaning price is going to continue to trade higher. And many traders would like to set a limit order above these highs. So let's say select the limit order here, that when price trades above this high, that would mean get me in a position going long, and keep my stop loss here below these recent lows, which are also liquidity because they're equal, right? So that's what they would think. I will go long here, keep my stop down here, and all the way up. It's gonna go up for a bit and then come all the way down, taking their stop, and because under the sell side liquidity. And that's a practical way of understanding what liquidity is. But there's more. There's always more. A swing high, right? And a swing high is basically the 3 candle formation. This is candle number 1, candle number 2, candle number 3. And candle number 1's high has to be lower than candle number 2. And the candle number 3 high has to be lower than candle number 2. So basically from these 3 candles, the one in the middle has to have the highest high to be considered a swing high. And when we see a swing high, that means price isn't willing to trade higher right now. And more importantly, above swing highs, there is a liquidity right above it. So it's an area of interest. Anywhere where there's liquidity, you would like to mark it out on your charts, because eventually price has to go to that level. And then we have the long-term swing highs. And the long-term swing high is a swing high with 2 lower swing highs to the left and 2 lower swing highs to the right. So this right here, the star in black, would be considered our long-term swing high. And as you can see to the left of it, it's a lower swing high. So look, candle number 1, 2, 3. These are our 3 candles of our formation. And in the middle, the high is the highest. So that makes it a swing high. And same over here, candle number 1, 2, 3. The one in the middle is the highest. So that's why it's a swing high. Excuse me. And when we see this, we can expect that the long-term swing high is not going to get ran through very easily, because it has a sort of protection, you can say. Because first you need to see the supporting swing highs get broken before you can expect the long-term swing to get broken. Meaning if price is currently trading here at this level, we would first need to see price go all the way up to take out this swing high, and then go higher to take out this high, before going all the way up to get that high. When realistically it would be easier for price just to trade down and take out the liquidity resting here. And that's called high resistance versus low resistance liquidity. And this is all gonna be explained later in this course. I'm just putting the idea in your head from now, So when it's time to actually learn it, you already have an idea of what I'm referring to and what I'm talking about. The next is an intermediate term swing high, and it's a similar concept to the long term, just with a less swing high to the right and a less one to the left. So it's just basically a swing high in the middle and one swing high to the left, one swing high to the right. And it's the same formation again. 3 candles, the one in the middle having the highest high. And when we see this, we can expect that the intermediate term swing high is not going to get ran through immediately. We would first need to see the supporting swing high get broken with a displacement before anticipating price reaching higher. And what the displacement is basically a strong candle one-sided. And this is all, as I mentioned earlier, all of the words right now are going to get explained in the other videos in this course. This is just to give you an idea in your head of what's to come. And of course, an intermediate term swing high holds liquidity above it as it's a trusted high and a good level of resistance. And they have the opposite, swing lows. A swing low is a common candle formation that forms when there are 3 candles, and the one in the middle having the lowest low. As you can see, candle to the left, one in the middle, one to the right. The one in the middle has to have the lowest low, and that's what makes it a swing low. And as you can assume, below swing lows is liquidity right below it. Same thing here with the long term swing lows, and it's the complete opposite of a long term swing high. So a long term swing low is a swing low with 2 higher swing lows to the left and 2 higher swing lows to the right. As you can see, the star in black is our long term swing low, because this one here to the left is a higher swing low, and there's another swing low to the left of that which is even higher. Same thing happening on the right. There's 3 candle formation. The one in the middle has the lowest low. That's what makes it a swing low. Same here, 3 candles. This red one, black and black, and the one in the middle has the lowest low. And obviously a long-term swing low is gonna hold a lot of liquidity below it. And we have the opposite, an intermediate term swing low. And an intermediate term swing low is a swing low with a higher swing low to the left and a lower swing low to the right. So here is our intermediate term swing low, the one in black, and to the right we have a higher swing low, and to the left we have a higher swing low. That's what makes it protected for a little bit, because now we know an intermediate term swing low price is not going to get ran through immediately. It has a bit of protection, and we want to see this get broken first before we see this. Now that you know what the intermediate term swing low is, let's actually go into the charts and see how it actually is. So we'll keep this to the side, and now we're gonna look for intermediate term swing high. Wow, it's right here. So let's see why it's an intermediate term swing high. This is the main swing high over here, and as you already know, just move this out the way, make it clear. Swing high here to the left of it, and the swing high here to the right of it, and both swing highs are lower than the main one in the middle. And what happens? So it's an intermediate term swing high, meaning it's not gonna get ran through immediately. It's gonna take maybe a day or two, or a couple of hours. So let's see how long it took. Yeah, it took 1 day and 2 hours for this high to get run through. So typically when you see an intermediate term swing high, you can and it's the bias is bullish. Bias is which direction that you think the market is leaning towards. Right? Don't worry, everything is going to be taught to you step by step. But first you have to understand these key basics so you can further advance yourself into the a bit more complicated areas and aspects of trading, and then you gotta put them all together to really perfect this. So the way I'm teaching you this course is step by step by step. I'm teaching you one part at a time, and then at the end you should be able to piece all of the puzzles together and be able to trade on a demo account first to practice. So as I was saying, this is an intermediate term swing high, and so usually when you see an intermediate term swing high and your bias is bullish, what you can expect to happen is price to come down, retrace for a day, take out some liquidity before sending price higher to take out the liquidity here in the swing high. As you see now, this intermediate term swing high will have lots of what above it? Lots of liquidity. Liquidity is extremely important in identifying which way the market is gonna go. So let's say above the intermediate term swing high, my bad guys, my hands were too fast. Above the intermediate term swing high, there is lots of liquidity above it. And what does that mean? That means that after a run on sell side liquidity, we can set the idea in our head that the next target for the market is going to be above this intermediate term swing high. But we will only think like this if the bias is bullish for this trading day or trading days. Not necessarily, when I say trading day, like sometimes it will mean trading day, like that specific day, but sometimes it means just for the week. But I will be a bit more specific, is bullish for the next trading days, for the next couple of trading days. Right? This is just bullish for 2-3 days. Because the market's consolidating right now, so it's going up and down, up and down. It will all make more sense, right? Above the intermediate term swing high, there's lots of liquidity above it. So price came down, taking out the sell side, then going back up, taking out the buy side, and now what's going on? Market is just consolidating a bit, or not much movement at all. But we can expect the next target to be below these lows here, around 36 pips from the current price. And this is the reason why market does what it does, why it's targeting liquidity. You really need to understand this aspect of why market is getting liquidity into the market. So the people who are controlling the market is not supply and demand, it's the big banks, right? And the big banks, they have created an algorithm to take out regular traders from the market so they can get more money and put it into their account. Because if you think of it like this, the banks aren't trading with the same account size as us. Like even like to have a good sized account for a regular person, maybe 5,000, 10,000, 20,000. That's a pretty good amount to have saved up of your own capital. But the banks are trading with millions. And how can they trading with millions, alright? And let's say they're risking a couple 100,000 per trade. And the trade goes their way 3 to 1, 4 to 1. Where is that $1 million gonna come from? It's gonna come from the bunch of regular traders like us, not like us. Bunch of regular traders who don't know that this is what the banks are doing. But we know, and that's the key difference. Right? So we'll see this, for example. What was I saying? That so the reason the liquidity is getting taken in from the market so that they can fund the large accounts of the banks. Alright, and the way this is shown is by liquidity to liquidity. As you see here, this sell side was taken, right? Was taken before it went all the way up. So when this sell side was taken, one or two things is happening. The first is that there are gonna be breakout traders entering short because they've seen a break of resistance. But it's not really resistance, it's liquidity. So the retail trader would think price came down, broke the resistance. Okay, I'm in short. I'll keep my stop above here. Again, they'll be trapped in short. The money will be taken from the account and into the market. Then once price goes all the way up, it's gonna take their stop out and take the money that has been set into the market into the pockets of those who went long. And those who went long are the banks. So that's what they do. They're taking the money from our accounts, from the sets, and going long. Not only going long, but going the other direction. They set a trap and they manipulate the market before sending price higher. So that's very important to understand. And let me find you an example of the swing low. Oh, this is just the intermediate term. Let me show you an example of a long-term swing high. And where could it be? Yeah, right here, for example. Or and if you look here, this would be our example of a long-term swing high. So here we'll mark out the key swing, the top swing, and then we have the smaller swing here and the smaller swing here. Just copy and paste it. Same over here, smaller swing. Oops. Smaller swing. And here's a smaller swing, here's a smaller swing. So this is a long-term swing high. So look, right now this is the current price, and price hasn't traded above it. Let's see how long that this high has been untouched for. For a month, basically 32 days that this high hasn't been touched, and it's because of this support here. As you can see, price came up here, broke, taking out this swing high, came back down, came back up, couldn't break this high, came back down, went up to break this high, but didn't break it strong enough. It probably just went up there to get the liquidity resting here, because as you can see, it's a bunch of equal highs. So there's liquidity here also. Price went up to take out the liquidity, and then you can expect price to come to this level over here with all of these equal lows to take out the sell side. And you can see it came down and it wants to take out more sell side, so it actually went all the way down here, take out the sell side liquidity here because of these equal lows. See, anywhere where there's equal lows, there's liquidity. And price came all the way to take it out before sending price higher till here. That's why the liquidity and the swing highs, that's how they work together, and to make it easier for you to identify what's going on. So now let me show you this intermediate term swing low and a long term swing low. Okay. And this would be our example of the intermediate term swing low. Quickly look at this area here and see if you can predict where are the points that I'm gonna put. So in this rectangle there's an intermediate term swing low. I'll give you a minute just to see where you would put it. Okay, I hope you got this as your answer. The main swing low would be here, and the two supporting ones, the first one would be here and the second would be here. And let me just make sure you understand what a swing low is. This is the three candles: candle number 1, which is this, candle number 2, and candle number 3. Candle number 2 has the lowest low between candle number 1 and number 3. So candle number 1 and candle number 3's low is higher than the candle number 2's low. That's what makes it a swing low. And as you can see, it's an intermediate term swing low, so that means there's liquidity below it, and we can expect price to make a run on it pretty soon, in the near future, basically in the next couple of days. So let's just see from this swing low how many days it took to take out the swing. How many days? 1 day and 16 hours, if you can see it here. That's why it's an intermediate term low. And the same thing is happening here again. This is called an inefficiency. Price came up to fill the inefficiency before going down, taking out the sell side before trading higher, taking out the other sell side, the buy side I mean, eventually taking out the buy side here. It's a pattern, it goes in circles. And let's find the long-term swing high. Excuse me, the long-term swing low. And here we have our short-term, long-term swing low inside this rectangle. So let me just point it out real quick. The main swing low, I hope you will guess, would be here, with the two supporting swing lows. The first one being here, and the second being over here. Alright, now on the right side, there's a swing low here, and a swing low here. And what that means is there's lots of liquidity below here, but these are acting as a sort of protection. So price would have to trade below it first, trade below this swing low, then this swing low, and just keep trading down before going here. There's too much for it to trade down. It would be easier for the market to just trade higher to take out this point of liquidity, for example. And as you can see, that's exactly what happened. Yeah. So basically, that's what a long-term swing low looks like. And let me just make sure that you got the candle formation down with the swing lows and swing highs. So first, excuse my drawing, but you know, I'm not an artist, I'm a trader, so I'll try my best for you guys. This is an example of a swing high. This is our first candle, and here we'll have our second candle. Oh. Just imagine that straight. And okay, so this here would be our swing high. Swing high formation. Candle to the left has a lower high than the candle in the middle. Also, candle on the right has a lower high than the middle. In the middle. Okay. Now let me show you swing low formation. It's gonna be the opposite. For first candle, second candle, and this would be our third candle. And as you can see, this swing low over here is the lowest. This is the swing low formation. Candle to the left has a higher low than candle in the middle, and candle on the right has a higher low than the candle in the middle. And what's the importance of this? And I hope you would know already, but let's just to be sure. the importance of that is below a swing point, there is typically pools of liquidity that the market is going to try and run. And what I mean try and run is eventually price is gonna want to trade below that level or above that level. And that's the formation of a swing low and a swing high, and the reason and the importance of it, of what it actually is. And the next thing we're going to talk about is the importance of the time frame and what the actual difference is in finding your liquidity. So let's see here. Understanding time frames for liquidity. The first thing you need to understand is that all of the swing points that you see, they will have liquidity either above or below it. And to determine when that liquidity is gonna be hit depends on the time frame you're gonna use. And also there's more like a sense of accuracy in what liquidity that the market is gonna be drawn to, if that makes sense. So let me show you what I mean. Let's go back to the charts. Let's remove all of this. Start here at the daily. Alright. So as you see here in the daily, there is liquidity below each swing. No, sorry. The first thing you need to understand about the time frames and the importance of it is that liquidity on the daily will have the most orders resting above / below it, meaning price will be drawn more to the liquidity on the daily and 4 hour. And the reason for that is each candle simply just takes more time to get made. So that means it's really a lot of orders above and below it. So let's take this example. Let's take this for example. Over here, as you can see, equal highs on the daily time frame. Those equal highs, what are they? Those equal highs are buy side liquidity. Buy side liquidity on the daily. On daily time frame. So there's a good chance the price is gonna trade up here in the next couple of days. So as you can see, 1 day, 2 day, 3 day, 4 day, 5 day, 6 day, 7 day, 8 day, 9 day. It took 9 days for price to take out this buy side liquidity before delivering prices way lower. Let's say we jump down to the 4 hour and go back here. As you can see, same thing. Price, look here, swing low. Yeah, what does that mean? Sell side liquidity is below it. Price came, look, everything in trading makes sense. It's all just logic. So what's the first thing we see here? First thing we see, price went all the way up. Not all the way up, price went up, taking out this buy side here, right? So after price takes buy side, what's the next logical thing? Price is gonna look to take price lower to take out the sell side liquidity, because it wants to harm the people that they have trapped. And the people they have trapped are non-informed traders who went long here, keeping their stops here. But price isn't gonna trade higher right now before taking out this liquidity. So price is gonna go up, take the buy side, trap some traders long, and take out some stops of those who are going short. So that's extra liquidity. That's liquidity taken from the stops and liquidity entering from the from the from the limit orders. That's what it is. So then price will come all the way down, take out this swing low, which has what under it? Liquidity. And this is on the 4-hour time frame. So this swing low here, made on the 4-hour, means there's lots of liquidity. There's good money under this. Good money. Dollars. We love the dollars. Alright? So then price came, took out the sell liquidity. So first thing, price took out buy side, got the money in the market, delivered price lower, got the money in the market. Now there's enough money in the market to send price to where it actually needs to go, and that's all the way up here, 270 pips above. So imagine the big banks have an idea that they want to send price higher, alright, and they want to trade it with a lot of money because they want to benefit. Who doesn't want to make money? Alright? So what they'll do is they'll take the liquidity from us, they'll fully grab it, they'll take the liquidity from the uninformed traders who are either going long or either going short. They will take the money, and the liquidity is above or under one or two things. You can see here equal highs and lows, and you can see here a swing low. This is what liquidity is under or above. These two, that's it. Price took out the buy side, took out the sell side. Enough money in the market. The big banks are opening their positions with a big lot size, risking a lot of money so they can make a lot of money. And then obviously price goes all the way up a crazy amount, 270 pips. That's insane. And so for them to get all of the money from going long, it had to come from somewhere. Where did it come from? It came from these traders, these uninformed traders who had their stops with the triggers above these buy stops and below these sell stops. That's where the money is coming in from. Because the money is not gonna come from thin air. It's gonna come from someone, or not one person, but a large group of people. And the best way that the banks thought is this: there's going to be a large group of people trading with similar rules and approaches. So what's the best way to manipulate the market so I can take their money and I can benefit for myself? That's what you need to understand. And that's how the liquidity works. It goes from liquidity to liquidity and then the move. Alright? And it's an algorithm. It's a coded algorithm happening the same thing over and over. So let's say we go down to the 1 hour. Go all the way back. Here. 1 hour. We can see the same thing happening as before. It's all very, very similar. Right here. What's resting above these stops? These buy stops, liquidity, because they're equal highs. Now we're on the 1 hour time frame, so each candle represents 1 hour. So when you see these buy stops are here, and we already know price is targeting this level here, right? Because look, price took out this buy side. Next thing would be, okay, price is gonna come all the way down, take out this sell side. Price went up here, a little retracement as we call it, made a swing high and relative equal highs, right? So price would come trade down, and here it wicked down the liquidity a little bit, but we don't want to see that. We want to see a strong candle, a very, very strong candle. So price made this swing high, made this short-term swing high. That's what we call it. And just one swing high alone, that's called a short-term swing high. Price went down, went up, took out the buy stops, and now there's a liquidity in the market from those guys thinking price is either gonna go long or had their stop loss for their short set here. That's where that money is coming from. Price is gonna go up, take that money, deliver prices to below the liquidity that we have marked out, because it makes sense. Price took out buy side, next thing take out sell side, but this buy side and sell side is on the 4 hour, so it's gonna take more time. Well, this buy side is on the hourly, so we can expect it to be taken out recently. Same thing here, swing low. What would that mean? Sell stops, right? So liquidity under this too, but it's on the hourly. Price went up, took out the buy side. Next logical thing would be the most recent sell side. And I really hope that makes sense. Go down to the 15 minute. Oh, I have to scroll again. Sorry, it's annoying, guys. It's annoying me more than it's annoying you right now. Yeah, here we are. Now 15 minutes. Now you can really see the liquidity taking place. Okay, look right here, equal lows. What's that? Sell side liquidity is under it, so there's liquidity down here. Price is gonna take this sell side and it's gonna go up to where? To the recent buy side. The market is just bouncing from liquidity to liquidity. Market is bouncing from liquidity to liquidity. See here, buy side over here, sell side over here. When you're first starting to trade and actually understand what's going on, it's very important to do what I'm doing right now, to mark out all the different liquidity points in different time frames and understand why price is moving the way it's moving. Okay, this is called an inefficiency. You'll learn more about it later over here. So price took out the sell side, came down to fill this inefficiency, and this inefficiency, when price is coming down to fill it, it means that we expect price to go up, which is called a bullish inefficiency. And it will all make sense, but just keep this in mind for now. So price goes down, takes out the sell side, fills this bullish inefficiency. So we already have the idea in our head that price wants to go further up. So where is the most logical area for price to go? To the most recent buy side, which is where? Over here, these equal highs. Price went down, went up, nice, almost 40 pip trade, taking out the buy side. That's a beautiful trade right there. It's really fantastic. It's 40 pips. You need around like 50 pips in a week would be a good target when you first start to make. Well, that's pretty good, 40 pips in one trade. And you'll be risking how much if you keep it below here? 15 pips, like a 2.5 to 1 return of risk, which is very good. So then price took out the buy side, and where did it go to? Price took out buy side and is in inefficiency. So where's the next logical thing after price took the buy side? To go to this new sell side here. It's gonna be our new sell side. And look, price went to take out this sell side, and after it took this sell side, where's the next logical thing it goes? You guessed it, to the buy side, which is where in these equal highs we get this wick above here, taking it out, reacting to this, which is called the order block, and you'll learn more about it, giving us another opportunity to enter short. Boom, look at this, look at all of this. Price took out the buy side, next logical thing, where would it be? You guessed it, these sell sides and these equal lows. Sell side over here, takes out the sell side. Where would it go now? To fill an inefficiency over here, or take out buy side, then take out much liquidity right here. Well, it kind of did, because there's liquidity here and these equal highs in the swing here. So price went up, took out the buy stops, inefficiency went all the way down. The market is moving for reasons. The market doesn't move just to move. There's a way that it moves, and that's very important. Price first wants to take out liquidity in the market, so that there is money guaranteed, that there's enough money guaranteed to actually pay out all of the winners. So once that money is guaranteed, what's gonna happen is price is gonna deliver, obviously, because now the money is there. Price is going to deliver higher or lower, depends on your bias. So price will take out liquidity, deliver higher until another liquidity point. And once it takes out that liquidity, you should expect price to come down the opposite way to take out the other liquidity. Right, now I know it's a lot of liquidity, that's all you're hearing right now, but it's gonna make sense. Okay, so let's say this is price, right? Price came out here, took this sell side liquidity, and then went all the way back up to take out this buy side right here. So what's the next logical thing? Somewhere over here is gonna, no. The next logical thing would be that price is gonna come, take out this sell side, right? And maybe there's a inefficiency somewhere here. Price will go up, fill this inefficiency, come back down, take out this sell side. Next thing you can imagine, price will go up, take out this buy side, and keep going lower. Buy side, sell side, buy side, sell side. Sometimes we'll go to inefficiency and continue higher, taking out the buy side. Price is just going from liquidity to liquidity, or to go fill an inefficiency. That's the only two things that it's doing. And that's it for this lesson, and I hope you got a good understanding of what liquidity is. Thank you.